anytime soon as far as the 2.0 is concerned, but just the rumor of it has slowed down, the process through the SEC from what I've heard. Not speaking on behalf of anybody either.
Yes.
So it's a question for you, Scott, and anyone else who wants to talk about it. So you talked about 20th versus 21st century and how incentives are better aligned with platforms. But it also seems that a lot of these platforms, they really are focused on an IPO or an acquisition. And the thesis is the bigger your asset pool, the more you've originated, the more valuable you are. So platforms are doing a lot of originations and buying other platforms. So it's not it's not a direct hit to you as an investor, but effectively there is some moral hazard there. So I sometimes question, whether it's 20th or 21st century, you still have incentives which are not perfectly aligned. Can you talk a little bit more?
You're 100% right. And it's categorically 20th century. Because you can call it whatever you like, it's still syndication. If I give you $100, $100, and you take $2 or $3 off the top, I'm bankrupt on a balance sheet from day one. Because I've actually only got $97 invested, not 100. So to answer your question, that is 20th century thinking. On top of it, from an IPO perspective, I understand where you're coming from, because again, the interests are not aligned. And in business, and I challenge anyone in this room, go and look at any relationship, be it business, be it personal, be it your employees, be it your wife, be it your husband. If your interests are not aligned, it is not sustainable and it will fail. And that, I think, you've raised two very, very valuable questions. And those questions need to be understood by people as to the impact that will have long term, in terms of as an individual investor and what you will or won't get from your return.
Yes.
And just to follow on from that, and really another question for you, Candice, is we talk about the disintermediation of these bodies that don't really operate fluidly and with the good interests of everyone at heart. I don't think many of these bodies have the intent of being detrimental. Governments, for instance, often introduce legislation with great intent, but the effect is often the opposite of that intended. A perfect example is rent controls. They sometimes say, why should these unscrupulous, racketeering landlords jack up rents to whatever they see fit at the expense of the poor, unsuspecting, innocent, kind, sweet tenant? So they introduce legislation to limit it to the CPI, for instance. What happens is, through unique circumstances, property values go up anyway, rates can't go up to match, so now the returns are lower, investors leave, the market gets tighter, rents go up even higher, but they can't, they're limited, you get a black market. The two cities in this country with the highest rents are the two cities with rent control, San Francisco and, some of you live in New York City, in parts of the city. So would you agree that often the people that we're trying to get rid of aren't intent on being inhibitors to a fluid market, but by the nature of what they do, they are? And this crowdfunding is one elegant way of eliminating them cleanly.
So I'm not quite sure how to answer that question. That was a beautiful testimony there. But what I would say is that
yes would work.
Well, no. But what I would say is even with the legislation, with the Jobs Act, the Jobs Act was intended to be a perfect piece of legislation. It clearly was not. And that's why we talk about the need for changes.
There's such thing as perfect legislation.
No, I don't think so. But what I will say is that what's interesting about the Jobs Act and what I really love about the process is that the SEC and FINRA have been responsive to the public comment and to public interaction. And that's not something I've seen in past legislation. I'm enjoying if you agree with that or not.
I mean, I think just to add to that, I mean, I agree with you 100% in terms of, how often can a middleman really and actually add value. I mean, again, if you take, in my country, we've got financial planners. I presume you call them the same thing, is it financial planning in America? And, at the end of the day, they get paid their money. It's a commission, it's a sale. It's no different from buying a car from whatever they give you. And, when you're setting up the structures and whatever, they are incentivized by certain different organizations to give, and so therefore their interests not aligned with your long-term interest. And the beauty with crowdfunding is that the more people have trust and transparency, and the more that you start to create wealth, be it $1, $1, $1 yen, $1 anything else, the less the middleman will be required, because people realize they can do it on their own. Because actually, to be honest, the knowledge that they have is no better or worse than the average human being, because investing is actually common sense.
I think add to that the diversification of private offerings. The ability to diversify because of the lower minimum investment amounts and the technology that's enabling that to happen. That's, you know, something that's more caring.
Terrific. I think we have time for one more question.
Candace, earlier you were saying that the Jobs Act doesn't allow the portal to co-invest with deals, but then you said that you guys will actually fund the deal and then sell.
We're not operating under the Jobs Act.
She's talking about Title III, because she was one of the early birds, so she
Title
is
III.
crowdfunding to be Title III.
All right.
But that's a great question, and what I will tell you is that most of the peer-to-peer lending platforms have found a way around the Jobs Act and are working under different legislative regimes to get to the ultimate product that they're selling. So not just us, Lending Club, Prosper, any of the platforms that you see out there that are live today are not operating under the Jobs Act. Quite honestly, the Jobs Act isn't useful from a debt perspective because there are other issues anyway, so we aren't operating under that.
Okay, terrific. Listen, thank you to each one of you for participating in the panel today. Thank you to the audience for participating.